Uganda, because commercial banks borrow money from the central bank and then later lend it out to individuals and businesses to uplift their businesses or expand their businesses. Now, meaning whenever we increase the central bank rate, the bank rates, that is the commercial bank interest rates, will also be raised. And that means it will be more expensive to acquire loans, and that will affect the way people lend, I mean the way people borrow money from the bank. So is the problem in Uganda? Is the problem all about the central bank rate? Or there are other external factors? Because according to the argument of Mr. Owino, ours is not the case of US and Nigeria and Ghana, because those countries are chief exporters, they are major exporters, but we are major importers. So mainly, we don't manufacture a lot, but we rather bring in a lot more than we manufacture. And so maybe the price increase are not being, being reflected or due to these internal factors like probably, a lot of money in circulation. Maybe that's not our problem. Maybe our problem is that we know the Russian-Ukrainian war has also affected the pricings of different things on the market. So we need to watch this, and we'll be talking more a little bit with experts on the matter of the central bank rate as we watch. Now, luckily yesterday, the Central Bank of Kenya had a policy review meeting, and they have decided to raise their interest rate in order to tame inflation. Now, the Central Bank of Kenya yesterday raised its policy lending rate by 0.5% to stem rising inflation and stabilize the shilling. Now, this increase in the central bank rate from 7% to 7.5% matched the expectation of most analysts who had said earlier that they expect the policy rate to rise further in coming months as the country fights off inflationary pressures brought about by rising oil prices and the economic fallout of the Russian-Ukrainian onslaught, which has hit food supplies. Now, the inflation, a measure of annual changes in the cost of living, hit 6.47% in April from 5.56% in the prior month. And the Kenya National Bureau of Statistics reported last month that the inflation had actually hit 6.47. Remember, in Uganda, we are standing currently at about 4.9%, according to the last reports of Uganda Bureau of Statistics. But in Kenya, the inflation rate is actually 6.47%. That is the general measure of the annual changes in the cost of living. Now, this has the highest pace. This has been the highest pace, since last September, when it stood at 6.91%. Now, the Central Bank of Kenya's Inflation Targeting Monetary Policy Committee (MPC) said that while the economy shows strong resilience, shocks from food shortages, a weak shilling, and imported inflation in the form of surging food prices could lead a spike in consumer goods prices if the liquidity is not tightened. The committee noted that elevated risks to the inflation outlook due to increased global, commodity prices and supply chain disruptions, and concluded that there was scope for tightening of the monetary policy in order to further anchor inflation expectations. Now, the MPC chairman and the Central Bank of Kenya Governor, Mr. Patrick Njoroge, said after its meeting, in view of these developments, the MPC decided to raise the central bank rate from 7% to 7.5%. Now, the shillings traded at exactly 116.71 on Monday, hitting a record new low against the dollar, setting the stage for costly imported goods such as cars, electronics, farm inputs, and second-hand clothes, as well as electricity amid a shortage of the US currency. Now, the weakening of the shilling has triggered fears of a fresh round of inflationary pressure, which has become a political headache for the government that has recently been forced to offer fuel subsidies to diffuse social tension. Now, the tightening of liquidity is, however, expected to have a negative effect on access to credit for individuals and companies right there. So the Central Bank of Kenya has decided to actually pull it off with a decrease in with an increase in their central bank, according to what they came out of their monetary policy committee meeting, that is yesterday on the 30th of May. And they have increased their central bank rate from exactly 7% to 7.5%, hoping that this will tighten the liquidity of the Kenyan currency. And the Kenyan currency has been weakening, just like Uganda shilling has been weakening against the dollar, with prices of the dollar going up and the shilling going down, meaning we as a country are grappling with the dollar as we import more than we export. And as we import, we use the dollar. And if the dollar is scarce, it means we shall need more shillings to buy out the dollar. So that is causing problems as well. And they hope that this increase in the central bank rate, the way money is circulated in the economy, and probably reduce on the inflation. But already remember, all governments across the world, and especially in Africa and other developing economies, are grappling with increase in commodity prices as the war in Ukraine and Russia continues to also have a grip on the exports and import of foodstuffs, especially food like rice, maize, and especially wheat. So you find that many of the people that are players in the economies are struggling to see that they remain food secure, but as well regulate prices of oil and other commodities. We will be talking more about that story later on the program, as we can see what the Central Bank of Uganda might have for the Ugandan economy in terms of their central bank rate. They will sit on the 16th of June as for their policy committee meeting to see whether the central bank rate, which is currently at 6.5, is also raised probably to 7 or 7.5 in order to curb inflation. But according to arguments from experts, our problem may not actually be the central bank rate. It could be other external factors that are influencing this. And one of those external factors is our, import appetite, that is very high. We import a lot and we spend a lot on buying the dollars rather than keeping our shilling. So that has affected our weak shilling already. And the shilling is losing so much against the dollar. And that has created a lot of problems for the economy as well. We will be talking about this and more later on, and as we get information from experts to see what can be done to see that the economy doesn't lose out in terms of the inflation and food security in the country. We're going to go into a short break. We return with more of the top stories as well. We are preparing for Mr. Andrew Mwima, who is a trading manager from Uganda Securities Exchange. He will be talking to us about what has been happening on the stock market, especially in Uganda and probably across the East African platform, so we can know what they have in store for you as an investor who is going to venture into the equity market. We are going into a short break. We return shortly.